Welcome to the Apartment Investing Show. I'm Paul Peebles, National Underwriter for Old Capital. And joining me, you probably know him, JC Castillo.
Hey guys, JC Castillo here with the Multifamily Property Group.
We thought we'd kind of introduce also Fritz with Doherty Mortgage. And we have a couple of questions that we wanted to ask Fritz about what's going on with that 10-year Treasury and what kind of an impact that's going to have on us as investors of apartments. So Fritz, what's going on with that 10-year Treasury?
Yeah, first of all, thanks for having me on, guys. Pleasure to be on here. But yeah, it's been a very eventful last 6 months or so. We had the 10-year Treasury hit, a pretty significant high over the last 6 or 7 years, but that hitting 325 late in 2018. But in the interim since, we've seen the 10-year drop to, it's sitting right now as we record this at 212. So it's a little over 100 basis point drop, which is, great for new buyers coming in to get cheap new debt on their properties.
What is the downside of that 10-year Treasury dropping?
So it's, as I mentioned, great for new debt, but if you had put on some sort of loan over the past 2 or 3 years with yield maintenance, as that 10-year has come down, it's made your yield maintenance costs go up significantly than it would have been, say 6 months or so.
So what kind of an impact is that having on lots of transactions where the yield maintenance cost is going up?
Yeah, it's putting a significant hamper on if you're selling a deal with long-term yield maintenance still remaining. There's other ways around that, as structure the transaction with an assumption. Most commercial loans, specifically Fannie Mae, allow for assumptions for a new buyer to assume the existing debt, and as well allow for supplemental loans up to 75% of the future value. So I think to avoid that yield maintenance, you'd probably have to structure it with some sort of assumption supplemental to get around that yield maintenance penalty.
And then another good side is because the interest rates has fallen, and a lot of the transactions for the last, say, year or two were debt coverage constrained, which means we didn't have enough net income on the property to get the loan dollars that we needed based on the higher interest rate. Because that interest rate's falling, what's that doing for leverage these days, what you're saying?
Yeah, it's definitely allowed for higher loan to values for loans over the last 6 months. I would say second half of 2018, we were seeing loan to values, in major markets, between say 65 and 70% loan to cost. Where now, as we move into the beginning part of 2018 or middle part of 2019, you're seeing LTVs back up to the 75% or 80% of cost that we've seen over the last 5 or 6 years.
Yeah, that's pretty amazing. I mean, that definitely stretches the buyer's pocket a little bit more. And if you talk to brokers out there, they certainly have seen, the pricing market come back up just a tad from where we were late last year when the rates were actually heading the opposite way. One of the things, Fritz, is I really want to focus on this because I think this is a really important topic here. Let's talk specifically about, again, Paul mentioned it, right? We're getting into a deal these days, and we're putting a 10-year, 12-year debt on this property, potentially. And pricing isn't going up the way it used to 5 or 6 years ago, so the equity is not coming up quite as much as it is from a natural perspective. So on the back end, if I want to be really safe and I want to exit this deal, let's say in another 3 to 4 years, and I'm not really going to hold that property for the full 10 to 12-year period, what are my options? I want to be real clear with the listeners out there. What are my options? What's the best strategy for putting a loan in place with you, given that scenario?
Yeah, I think you just need to try to find creative ways to, reduce that yield maintenance exposure. So, traditionally, like we've seen, like in a 10-year deal, we've had 9.5 years of yield maintenance. There's situations where you can buy that down to say, 7 years of yield maintenance, or do a 7-year term with 5 years of yield maintenance. And outside of just the yield maintenance factor would be to do a step down prepayment. So say on a 10-year deal would be, first 2 years at 5, then 4, 4, 3, 3, 2, 2, 1, 1. And that calculation is a little easier for everyone to understand, where, the yield maintenance calculation is pretty complicated, and there's a lot of external factors that can impact how that cost goes up or down. So I think it's really just trying to be creative with your debt financing to making sure it aligns with your investment horizon goals.
So what you're saying is that you have choices. You just don't have one thing, but you have a kind of a smorgasbord of different things that you can pull back and forth, whether it is a lower term, or you can even reduce the amount of yield maintenance up front if you needed to, knowing that at the backside, you're going to sell this property within 3 to 4 years.
Now, what's the downside, Fritz, to somebody coming in and wanting to do that? So, let's say I want to do a 7-year term with 5 years of yield maintenance, or I want to step down prepay. What's the negative impact of me wanting to get that done?
So in terms of going shorter in term, things that investors really like are interest only. And so, I mean, what people love about the longer term debt is you can get, longer term interest only. And if you're, going down to say 7 years, you're not going to get the big long term interest only, just because it's just a shorter term, and how Fannie looks at their exit analysis. They're not going to be as aggressive on the interest only. In terms of, pulling down the yield maintenance costs, or even doing the step down, you're reducing basically the call protection for whoever's holding the debt, and so the pricing is going to be a little bit more expensive. So, say for example, a 10-year term with 9.5 years of yield maintenance will be about 20 basis points lower than, say, doing a 10-year term with 7 years of yield maintenance. And you generally, for the step down first yield maintenance, it's generally about 25 to 30 basis points. So there is a trade-off than doing the longer term yield maintenance. So it'll be a little bit more expensive, but you just need to mirror and figure out what exactly your goals are for the asset, and making sure that your debt is aligned with that.
All right, absolutely makes sense. Hey, listen, you were up in the Pacific Northwest with a Fannie Mae annual conference. Tell me some of the takeaways that you got from being at the conference.
Yeah, and it was a great conference. I think overall, the agency lenders, specifically Fannie, is very bullish going forward. I think there's still plenty of liquidity in the marketplace, and so I don't really see them taking a step back anytime in the next 12 months.
But you were also mentioning about these two different buckets, capped buckets and non-cap. Tell us a little bit about what that means real quick.
Yeah, so each Fannie and Freddie have about $35 billion that they're allowed through the regulator to lend on each year, and there's certain types of transactions that are not included in that bucket. So, for example, and for Fannie, if you're doing a green rewards, green financing deal, it does not count towards the cap. If it has some sort of affordability, so rents below 60% of area median income, or manufactured home communities, do not count towards the cap. And so they're going to be more aggressive on pricing on those deals, because they can do basically as many deals as possible. Where a traditional A- deal, if you're refinancing a new construction deal, or it's a B+ A- deal where rents are maybe 80% of AMI or higher, the pricing is going to be wider than it would be if you were doing a green rewards loan or a deal that has more affordability, just because they have certain limitations on how many deals and loan volume that they can do in that bucket.
Okay, so the takeaway really is to try to get on every transaction somebody's trying to buy, is get as much green rewards out of the property.
Yeah, definitely. I mean, it'll save you anywhere from 30 to 60 basis points by going forward with the green rewards program.
That's great. Some great information on that. Fritz, we appreciate you being visiting with us today. Hopefully we can call upon you in the future just to check in every once in a while and see what's going on the Fannie Mae side. So we appreciate that. JC?
Well, hey, Paul, why don't you tell folks online how they can get a hold of you if they want to do some business with you?
Again, Old Capital Lending, so oldcapitallending.com. So visit us on the web or listen to the Old Capital podcast. We appreciate that.
If you want to get a hold of me and schedule any time for a consulting session, I offer a 15-minute consulting session. Go to multifamilypropertygroup.com. You can check our website out. You can go to the contact us page and get in touch with us. Thanks a lot for joining, and we'll talk to you soon.
Thanks, Fritz.
Yeah, thank you guys. Thanks for having me on.